Hello, welcome everyone. Good morning. We'll start our lesson 3. Today lesson will go through LO3, learning outcome 3. As you know me, my name is Anjum Sattar. Please, if you have any question, drop me email anjum@ukversity.co.uk. Today lesson, which will be about be able to evaluate the budgetary process or processes of an organization, which will go through what is meant by budget, how we can prepare the budget. And today lesson key command verb evaluate, develop, and recommend. You can evaluate and develop the budget, and then of course we can recommend based on recommendation. And today lesson indicative content, what we're supposed to learn is type of flexible budget, fixed budget, zero-based budget, budgeting process, subsidiaries, master budget, relationship between budget and cost, and quality control, and we'll go through the budget. Budget is a financial plan for future. Budget always is a provide the set nav, where we are, where we like to go. So budget provide the guidance for the future. So on scale 1 to 10, always good to be any activity will start. You reflect, what you know about budget. So anyone, please? Okay, good to reflect. Budget and the budgetary control, how much we know about the budget and budgetary control. We have 3.1, evaluate the budgetary target for an organization, which will go through what is meant by organization. So budget is a financial plan. A budget can be a plan expressed in money and is prepared and approved prior to the budget and the period, and may show the income, expenditures, the capital to be implied, and may be drawn up the shown incremental effect on the farmer budgeted and actual figures. So budgeted and actual figures. So the difference will be known as a variance. So what is the variance? Variance is a budget and actual figures. You budget £100, you spend 120, so £20 is a variance. Variance is a difference. That type of variance is adverse. So effect of the running and the business management and must be known where it intend to go, organizational objective, and intend to accomplish the objective of the plan. Whether individual plan fit with the overall organization objective. Objective mean end result, what we want to achieve at the end of the year, at the end of the period. So budget is a control device, that the company use all these purposes. So what is the budget? Budget is a financial plan for future. So budget preparation, sale budget, we look around the quantity of the sale, the forecast. Any budget you want to make, so you have to look around the sale forecast. If we are expecting the sale will go up, then we can increase our production, then we can use our material usage budget and material purchase budget. So these are all the subsidiary budget based on the sale forecast. So if the economic activity good, sale expecting increase, and we can look around and we prepare the budget. Okay, so preparing budget. So sale forecast, production budget, material usage budget, labor budget, overhead budgets, material purchase budget, labor cost budget, and overall we can call it the capital expenditure budget. How much is the expenditure we have for the business? So that's really we need to be look around, and we have to prepare the budget accordingly. Okay, so when we making any budget, so always good to be look around the base, rejected, and efficiency. So budget help, so always like we expecting 10% the wastage. So you have to make it, the goods like 100 is a demand of the goods we produce and sell, but 10% is a weight. So you have to produce 110. So in the adjustment you have to make, the wastage always need to be in count, and inefficiencies, like a wasting time, those are setup time, those we need to be keep in mind. If we'll say, 10 hours is required to make 1 unit, so you have to make sure, that we make all the budget accordingly and according to that's, really achieving all the desired objective. Okay, so then we always looking when waste and reject, and inefficiency. So is required, the manipulate the formulas. Suppose 2% the gross of the production rejected, like I mentioned, 10% example of 100. So if the total production required 229.40, so this is you have to times by 100. divided by 98. So you have to make it 3000 units. So you have 60 scrap, or we can expect it there will be the value of the unit. So exactly we can look around even in sales, the wastage and inefficiencies need to be embedded in our budget. Okay, so wastage, incorporating the waste into the budget. You maybe draw, the production cost in the budget, and which obviously have include the cost of the material used in the production. And we know that the material purchase and the material used in production. So always if you want to calculate, we can look around the material used in plus the closing inventory minus, so we can find how much material is required to purchase, and use in the production process. Sales minus cost of sale, which is formula is closing inventory, we can look around, and opening inventory and we can find, how much change in the inventory and rejected or the faulty production, and we can find the productions, how much is required. That is quite crucial, which we have to. Overhead charges, always overhead mean not directly involved in the production. Those are indirect expenses. Those we need to be embedded, those we need to be keep in mind when we budget operating statement. Like you have a sales revenue, you can find the cost of the sales, and then we can look around mine at the closing inventory, opening inventory, material. So we can look around, and then we can find the gross profit, and then we can minus our head. Our head is indirect expenses, those will go through some example. So always in the budget, look around the capital budget. Capital budget is related capital asset, like, you want to buy them plant machineries, so, or any other assets. So these are very important assets, which we need to buy and use them into production process, because if we don't buy them or don't use them, ultimately it's cost us, and we can't do the economics activities in the long run as organizations. We have to make sure we'll carry on and producing these required, the units accordingly. Okay, integrity of the budget. Integrity mean, the word integrity mean honesty. So we should be honest with the budget and the performance, and performance standards should be realistic, and it will be set, accordingly. So that is quite crucial, which we need to be make sure we have all, the required resources accordingly. Okay, guys. So hope so you can see the slide. Okay, so today is we looking, as we mentioned earlier, you can reflect what is the budget. 3.1, we looking the budget is a financial plan which expressed in the money term, which I mentioned you earlier. Budget prepare, the sale budget, sale forecast is the first. Then you can make production budget, material use budget, material purchase budget, labor budget, cash budget. So sales budget, then production budget, then material use budget, the labor budget. So these, and then overall budget is capital budget, which is how much is required for capital assets. So when you're making the budget, we earlier I mentioned you the budget need to be embedded, any waste, any waste, any scrap, that need to be embedded, in the budget. So those we need to be keep in mind as well. Okay, so waste, those need to be when we looking like here, I earlier mentioned you as well. If it's a 2%, 2940 unit required, but 2% is a waste time by 100 divided by 98. So we need required 3000 unit to produce instead of to embed it. Then we said, the waste need to be incorporate, the sale of closing inventory minus opening and chain inventory, how much rejected faulty goods, and how much unit required to produce, for the production budget. Overhead is known as the indirect expense. Those not directly count, but it's count towards, so those we need to be. So we can look around the sales revenue minus cost of sales, opening inventory plus purchases minus closing, less, the cost of sales, we can say gross profit, overhead, and then we can find the operating. Capital expenditures mean, the expenditures, those are required for long or high value expenditures. Integrity of the budget is mean honesty. We need to be honest with the budget. Any budget we making, we need to be make sure. Okay, guys, so I included the example of the budget. So we've been given the activities. You can look around, like we have a sale, purchase, wages, and on the basis of this, we are making the cash budget. So 50% from our customer debtors we are receiving end of the first month, and rest 50% end of 2 months. 50% purchase. If we do one supplier, then 10% we'll get discount. It means 90% of the payment we making them. New equipment, how much cost, and we need to be. Okay, so we can make the template. We are making the budget July, August, September, October. How much is the opening balance? Then how much receipt we are receiving the money, and we can look around total receipt minus total payments, and we can say how much is the cash. So in our question, we've been given the sales we do in July, August, September. So 50% we receive in the same month, 50% in the following month. So in August, 50% August sale in August, and so on. So we'll do in July, if we'll do any purchase, 50% of that, but we making the payment 90% because 10% we are getting discount. So that's 12,500 times by 0.9, so that will be 11,250. And we can look around these, that's quite crucial, which we need to be look around, and that's which we can calculate that way this budget. And 3.2 we need we need to be look around. So we need to be look around the budget when we make the budget, preparing the sale budget, initial preparation, negotiation, coordination is very important in any budget. And that leads to the budget master budget. Okay, so rolling budget, the budget, these are different types of budget. Rolling budget means this period budget can be rolled over the next period. We not, and it's less time consuming. So those, is very important. That's why it's very important. So we need to be make sure, we'll make the budget according. Okay, so we need to be look around. We need to be we need to look around the reduce the uncertainties and upgrade the budget the way is available. Planning disadvantage of the rolling budget is involve the more time, efforts, and the money. And frequently budget can be have a detrimental effect on because the manager. So that's why we rolling budget is sometime we can roll over, but the problem is not reflecting correctly. Incremental budget, the budget which is increase the budget. So last year the inflation, like we have to embed the factors. Zero based budget is like a new budget. Every time you start with the zero, there is no previous information. So every time you're not looking the previous years, you estimate everything again from the scratch. So that's called zero based budget. So zero based budget has its own advantages and disadvantages. Those we need to keep in mind as well when we making the budget. So advantages of zero based budget is identify and remove in efficient or obsolete operation. Disadvantage involve the time and the effort required. Is the ranking can be quite prove and the problematic or problematic because that's sometimes is difficult because you don't have a facts and figure, right? And that can be misled. So we can prioritize these the things. Priority based budgeting can be prioritized so those we need to be look around budget based on the budgeting, the advantages of the activity based budgeting. So that's welcome Osama, you okay? How you keeping?
I'm fine, thank you. Sorry.
Okay, no, that's fine. So today we are discussing about budget. We discuss any budget will make. First thing is the sale forecast. Yes. So if the sale we expecting more, we are making more budget. Then we can make the sale budget, production budget, labor usage budget, all budget. So budget is a financial plan for the future. I'll do a bit recap as well at the end. So activity-based budgeting, as the activities increase, like you're producing more, your budget need to be more. So activity-based budgeting is quite good technique. All type of budgeting, whatever the budget you will use, budgeting technique. If you serving more people, you need more money, you need more, production. So that's, activity-based budgeting. But activity sometimes is a difficult to estimate thing. That can be a problem. Sometimes is a cost. So each budget type has its own advantages and disadvantages. Budget, sometimes demotivate. Budget also help you to motivate as well, because if we achieve the thing within the budget, within the cost, within the standard, that's quite crucial. But sometimes the budget can demotivate people, because you're not receiving the desired objective within the cost, within that time. Sometimes the managers make, couple of you, maybe you watch the program Undercover Boss, go at the ground and understand the reality, like what is actually required, because sitting in the head office and making the budget maybe demotivate people. So that's bottom up budget. What is the bottom up budget mean? So we can get all the information from the operational level, and then we making the budget at the top level. So that is called bottom up budget. So the budget is based on the detailed knowledge of the manager, the motivation of the managers to achieve the budget which is set out, to increase, and the manager committed to the strategic plan the long term. So sometimes dissatisfaction from the negotiation with the budget committee, and sometimes it can be slack. There is actual result compared to the budget, it can be a problem, and sometimes maybe more time required involved, so taking everyone listen them and then making the budget at the top level. Okay, then we have 3.3, critically evaluate the budget and the budgetary control process. So budget control is a useful comparative system. So we can make budget, like you make a £100 budget, but actually what you spend it's quite useful planning, coordination, and control. So division and the functional basis, like we have a HR budget, we have marketing budget, we have a sale budget, we have a production budget. So each department is known as a functional area. So forthcoming budget, so level of performance against the budget, we can compare with the same size of the companies in other areas. So when we're looking the classification of the budget, we can do the long term budget, like 5 years budget, short term budget, a year budget, medium term budget, current budget, rolling budget. Rolling, what was the previously, we roll over every year. So according to the functional, sale budget, production budget, cost budget, personal budget, research and development budget, like the Nokia, they closed many research and development center throughout the world. That's why the problem was they not achieve the desired. So we need to be look around. Fixed budget, the budget will stay the same. The flex budget, the budget will carry on changing with the level of output. That's the which is, so fixed budget, the budget will stay the same, and the basis of the estimate and the volume and the production and estimate volume of the sale and budget variance. So we need to be look around. That's really we need to. So that stay the same. Flex budget, as the word indicate, the flex is a variable budget. If your production increase, your budget increase, your activity increase, your budget increase. Like NHS in the UK, we have a waiting time increase. Standard is 2 hours. If you go A&E, it's up to 4, 6, even 8 hours we have to wait, because that's not in line with the activity, because the population increase, the usage increase, but the budget not being in line with the, so that can create a problem. Okay, so preparing the flex budget, which is cost behaviors, we have to look around fixed costs and variable costs. That we need to be look around. Is it, how much is the fixed, how much is the variables? We have to look around the flex cost, the cost which change with the level of output, which will go through the example on the next slide as well. Okay, like in the flex is mean is the carry on chaining. So we have to look around the fixed cost, the cost which stay the same, variable cost, the cost change, the semi-variable mean fixed and variable together, and you have to flex it, according to the activities. If your activities like manufacturing unit, if you're producing more unit, you need more budget. If you're doing more distribution center, more distribution department, many miles you are in the personnel department, if you look after more, you need more HR manager, you need more budget for it. So like here, if we look, the sports, the J's prepare the budget profit forecast based on 90, 100 and 50,000 units. The 90% are 100% of 50,000. So we have to look around and the 105% activity. So actually we are producing 37,500 units we are selling. So we can look around the sales revenue on the 90% of 50,000 units, and we can look around 100% of and 105% off. And actually what we have, so we can compare it, the cost and the benefit of that, which we'll go through on the next slide, is being given. So if you're producing 37, so you have to be really, your activity is 37, you can't really compare, you have to flex it 37,500 times. If you're selling 30 pound per unit, you times by, so you can compare the flex budget, that's your estimate, that's your standard times by. So there is a variance, the variance is a difference. So A is the adverse variance. Material, because you budget more, actually you sold less. Material, you have, you budget this, but actually you spend it, this is adverse. So we can look around, the labor is adverse, uh, uh, production overhead is adverse, admin is at favorable variance, because with 70,000 actually we spend it 665. So overall, if we look, the variance is adverse variance. We expected that profit, but actually the profit is went down. So we have overall adverse variance. Any question, Osama, here, if you want to?
No, it's fine, thank you.
Welcome. So all being the calculation we've been given here, 1.5 million divided by 50,000 units. So we can find the cost of the unit. Then we can look around exactly the same, you've been given the total cost, you find the per unit and how many units we are producing, so we can flex it. Yes, sometimes it can be difficult to divide the cost, because activities can be different, and at the different, and the moving averages or moving targets can be different. Okay, so I included some background reading, please. These are the two case studies: Planning Budget Davis Group in the UK, and the Zurich, the insurance group, which is quite big company. And that's, we can read the case studies. And then I included the video, what is meant by budget or the budgetary control, and how we can do it. And at the end is a quiz there, yes, and the recommended resources. So I'll take you back, because at the starting, what we said earlier, we have three in our assessment criteria, which is LO3 was be able to evaluate the budget and budgetary process. And we had a discussion about what is the budget and budgetary control. Budget is a plan expressed in the money, which we discussed. Budget control is a device that company use for all, as in our daily life we make the budget, and budget is a crucial. Sale, we said sale budget, you have to do the sale forecast, sale budget, and the production material and all other budget depends on the sale forecast. And then we said, if sale, then production, then material usage, labor, overhead, and cash budget, we can prepare accordingly. Then we said, sometime you budget 100, let's say there is a demand of 100 units in the sale, but 10% is a waste, so you have to make it 110 to adjust the wastage within your budget. So that's, you accept, reject inefficiency, that's all embedded into your statements, and corporate and overhead budget, which is mean indirect expenses, budgeted operating statement we can prepare, how much is the cost, how much is the revenue, the gross profit, and things, which we had a discussion earlier. The capital budget is the overall budget, and this mean, investing long-term integrity, see in the budget, performance and performance standard need to be realistic. And then we included the budget, actually is a cash budget there. We've been given the sales, purchase, wages, then we prepare how much is the receipt, how much is the payment, and then we divide it, because you have to set the policies, so your cash need to be inflow. So that was our LO1 and 3. LO3 3.1. And then we went through 3.2 master budget and different organization. Why is it important to make budget? Overall budget is known as a master budget, like whole country budget is the master budget, but each province is the uh, sector of economy, that's the subsidiary budget. Then we discuss about types of budget. Rolling budget is the carry on rollover 1 year to other years. We discuss zero based budget, starting every time from the zero. Incremental mean you adjust the inflation, like if the 10% more payment required. So that's all, which we discussed today lesson, and 3.1 which we just went through. And please, if you have any question, Osama, any question?
No, it's fine. Thank you.
Okay, so next lesson we'll go through LO4 and then we'll go through LO5. Thanks for attending. Have a lovely weekend, and I'll speak to you the next lesson.
Okay, thank you. Thank you. Cheers.
Thank you.